But the sign that we're really close is going to be the gold to silver ratio, which hasn't really moved down. By down, I mean silver moving up. I think we're still at like 88, 90 or something. I haven't checked it in a while, but it's nowhere near any kind of end game territory. But I do believe that when we start to move down to the 15-to-1 ratio or towards that area, it's going to be fast. And when we start to see that move, it's going to be really fast. I don't know when it's going to start, but once it gets going, we're going to get there quick. There's not going to be time. I don't think we're testing any limits. I mean, the limits, the actual limit would be the 1980 limit taken by the Daniel Oliver calculation of if you take the market price of gold and you multiply by the amount of gold that's supposedly represented by the Fed's gold certificates, how much of those, if you take the total dollar amount of that, what percentage of the Fed's other liabilities is it back? And the peak in 1980 was 130%. That was too much. That's why gold fell after that. That's functionally a gold standard. Meaning if you take everything on the Fed's balance sheet, including all the debt that it has, and then you take the gold part of the balance sheet and you make it balance out the debt, meaning if the debt disappears, you still have that same value in dollars in the gold or purchasing power in the gold, then that balances the balance sheet. That's what it's supposed to do. So I think we're still at like 7-8%. We're nowhere near the limit. I think the limit would be if we're going to have the 1980 numbers of 130%, which we had for one day. I don't expect that. That's not equilibrium. That's not going to be sustained. But 130% would be like $90,000 an ounce, which we could get if the Fed completely stops printing. And then a banking crisis ensues, right? And then we get to 130%. That could last for a day. We could hit 100% for maybe a month or two until a new derivative system crops up and then replaces the old debt with a new debt, some kind of haircut system or something like they did in Europe during the sovereign debt crisis. Something that could happen. But yeah, 3,060. It's nowhere near any kind of limit. What's causing it? This is always a fun game. You could always try to point to the proximal cause. Yeah, I think it's this, I think it's that. I think the mainstream media is saying that it's the tariff threats and Trump is threatening tariffs on this, tariffs on that, and breaking down international trade. The proximate cause doesn't really matter. I'm sure there's a more correct answer and a less correct answer, but the beauty of understanding that gold and silver are money is that it doesn't matter. I mean, and then once you know that the end game is that gold and silver will balance out the rest of the Fed's liabilities, meaning all the purchasing power will go into the debt. As the debt loses value, gold and silver will gain value. Gold will gain value because it's on the balance sheet and because that is the money. Silver will gain value if the gold derivatives no longer work, because if the gold derivatives no longer work, there's no other way to divide silver, to divide gold, and that's why silver will go up. So it's nice that gold's going to 3060 because I want this whole thing to end as soon as possible, just so society can move on. But the sign that we're really close is going to be the gold to silver ratio, which hasn't really moved down. By down, I mean silver moving up. I think we're still at like 88, 90 or something. I haven't checked it in a while, but it's nowhere near any kind of end game territory. But I do believe that when we start to move down to the 15-to-1 ratio or towards that area, it's going to be fast. In 1971, I think the total amount of time that silver was actually moving up in the 1979-1980 era, and that was most of the move. I think it was a total of 4 months, right? Excluding the parts of 1979 where the gold to silver ratio was stable, which was like 2 or 3 months in that year. So, so I think the whole thing was like 4 months. So we're gonna see a move of about, from 90 to somewhere around 15-to-1. And when we start to see that move, it's going to be really fast. I don't know when it's going to start, but once it gets going, we're going to get there quick. There's not going to be time. I'm seeing the outflows from London to COMEX, or from wherever they're coming from to COMEX. It could be using London as an exchange. It could be physically from London. I think in the case of silver, it's physically from London to the COMEX, but it doesn't matter where it's coming from. The fact is that it's coming into New York, and I've been trying to find an answer as to why this is happening. I had on my channel Eric Young, I published a video yesterday actually, and he's a COMEX expert. I talk about it sometimes, but that's not really my area of focus. My area of focus is like the plumbing of the central bank system and the depth, the deep dark depths of the monetary system led by the Fed. So what he said is that he thinks that there's an inflow into New York. Meaning the mechanical question is, we understand why there's an inflow into New York because for some reason gold and silver are more expensive in New York than they are in London or other places in the world. So what you would do is you would buy metal abroad and then ship it to New York and sell it there, and then you pocket the difference. There's always just money flows. It's like where do you get the most money from? And right now that's the trade. Now the question is why. So for some reason there's a premium being demanded for gold and silver in New York, and I don't know why. But Eric Young's opinion is that the U.S. government is buying gold. Now, I'm not sure if I agree that might be true, but and I guess the reasoning is that the government is buying gold and gold bugs, we want to say, because they see the end of the fiat era, and therefore they want to buy gold to try to back whatever a new dollar would be, and then do a debt reset. Maybe I don't know. I don't think so. But I could be wrong. But you see, either way, we go back to the first point. It doesn't matter. If you own gold and silver, it's like it doesn't matter why this is happening. Either like because at the bottom line, the gold is the money. If you have that, you'll be fine. Whatever the reason for it happening is. So if he's right, he could be right about the gold. Maybe the U.S. government is buying gold and trying to back the new dollar or restock Fort Knox or whatever we want to think. And I spoke to another guy, I think his name was Mayor Valinsky, who actually believes there is no gold at Fort Knox. So if you want to take those two theories together and say that the Trump administration or whoever understands money in the Trump administration, I don't think many of them do or any of them do, but I think they understand it better than the Biden administration, which doesn't understand anything. Could be right about the gold, but then why would the U.S. government be buying silver? It wouldn't be. Like they'd have no use for that. So then you could say maybe, okay, so somebody caught on to the U.S. government buying gold, and then so there's a premium on silver too in New York. Okay, fine, but then we're kind of getting convoluted here, and as to what's really going on, nobody really knows. But what Eric also said, King Kong 9888 on Twitter, is that the float on physical gold at the LBMA in London is 0, which is why there's like a 90-day waiting period. I haven't tried to buy physical gold from London. I don't have the money to do that. So I can't tell you from firsthand that's what's happening, but I hear that's what's happening. And with silver, the float is something like 5,500 metric tons left. And every day now, if you check the NYMEX page at the CME website, there's like between 1 and 4 million ounces of silver flooding into New York from London every day. So if you take 5,500 metric tons, you divide it by 5, like this is the average of 1 to 4 million, let's say like 2.5 million ounces a day. That's something between 5 and 7 months until the LBMA is out of silver. What happens then? I guess we're going to find out. Because the more monetary stress that we're under, the more silver is going to flow into New York, just because that's the double-edged sword of being the world's reserve currency, that the real money is going to flow towards the reserve currency. I guess you could analogize that to something like an immune system reaction. When the body is under attack, like the main organs get most of the blood. So I think the monetary system is under attack now, not by any, I'm not saying by any like nefarious conspiracy of people, though that might be true. I don't know. But I think just the nature of how it's been abused is causing this reaction. And I think it's going to continue until gold and silver run out from other places. And then we'll see what happens from there. If you're a foreign central bank and you're relying on the dollar system, then let's say you're in a currency crisis, and then in a banking crisis, then what you're going to do is you're going to try to weaken your currency to keep your banking system alive. So you'll buy more of your reserve. You'll buy more dollars. I remember the Bank of Israel doing that here when the shekel was strengthening. They bought more dollars. I think it was because of the war, other things like that. So when you are the reserve currency and your currency is strengthening, right? To weaken it, what else can you do but buy your reserve? If you're the reserve currency, you can't have other currencies in reserve. I mean, you can technically, but they're not going to. That's folding back in itself. Like you have to go down a layer. So your reserve is going to be gold. So you could say that the central bank or its proxies or something or some other bank that it's controlling is buying gold in order to preserve its own banking system, because there's nowhere else to go in the pyramid. So that would be if the reserve currency is under attack, meaning its banking system is under attack, meaning the currency strengthens because there's a dollar shortage or some kind of financial crisis brewing that we don't quite see yet out in the open, but it's happening. Again, like remember, like before the 2008 crisis, gold was going up and up and up and up for like 6 years, right? It wasn't stopping. And before the 2020 crisis, it was also going up, and then it spiked at the end of the crisis. So we're seeing that now. So this means like this is the early innings of a financial crisis. When there's a financial crisis, the dollar goes up in value as huge demand in a liquidity crisis, liquidity crunch, and so the mechanical response is to acquire more of the reserve asset with the dollars by creating more dollars to buy that reserve asset. I would say directly, I'm not saying the Fed's printing money to buy gold, but I'm saying this is, it happens in more of an organic way that I can't really explain, but it's happening now because you're seeing the flows. I mean, we're not making these things up. So that's what I think is happening. I think we're at a strengthening banking crisis or financial crisis or some kind of crisis that involves the dollar strengthening, and that's why gold is flowing in.